Lord.
There we
That's
go.
not today.
Hey. That's a nice size crowd. Yeah, if you have your cameras, wave and say hello. And let's kick this. Yeah. Hey, Sally. There we go. Absolutely. Very nice. Very nice.
Good morning, Eddie.
Good morning. How you doing?
Fine. How are you?
Living the dream. Living the dream. Yep. So welcome to Saturdays with Eddie. Today is September 17, 2022. This is the usual Saturdays with Eddie session. It is completely free to you. I try to do this every couple of weeks, and it is geared towards everybody. So you can invite pretty much anyone, everyone, your neighbor, your friends. Does not matter. There is no cost. There is no hindrance. It's basically open. And the idea here is for me to connect with the community, give back what I know, try and lead you guys down the path of options trading. This is what I do best, options trading. I recognize that we have different backgrounds, which is very, very welcome. So we all need diversity in the house. Understand that our methods are not necessarily the best. They're not the only ones available. There are so many ways to achieve the same objective. I think most of you are here because you want to make money using options or using the stocks in the stock market. Yeah, I think in general that's what's going on. So I am here to help you. There's no damn question. The only damn question is the one that you do not ask, right? So if you don't ask the question, guess what? Nobody's going to help you, right? So don't be shy. There's no bad question. Just ask it, and we'll if I don't have the answers, I'll try and find you the answers, or somebody around here is going to know the answers. So we'll try and help you as much as possible. In terms of what level is required to take advantage of this session, it really doesn't matter. If you're coming in cold the very, very first time, or you just learned how to spell stock, or you just learned how to spell options, that's okay too. That's all right too. Now, I don't spend a whole lot of time talking about stocks because I know, and you know, that once you start trading options, it is very, very unlikely that you're going to go back to trade stocks. The amount of leverage, the amount of benefit, the experience, the profitability, it's exponential. It helps you a lot. So that's where we're going to start. And then because we have a lot of new people that I have not seen here in quite a while, or I've just never seen them, I want to say welcome. Welcome. Usually I have a small agenda, but I like to build the agenda as I go along. So what we will do is I'll tell you what I have in mind, and then you can tell me what you have in mind, and we'll go from there. So essentially what I have in mind today is, we've got the welcome message. So check. Here we go. Part of that welcome message, by the way, I am not a financial advisor. I'm not licensed. I am not certified to tell you what to do. What you do is up to you. I will not give you financial advice. Did I say that? I am not a financial advisor? Yeah. Let me just say that one more time. What I say here is for educational purposes only. So take it with that in mind, and understand that even over here, we don't have any financial advisors. If you're a certified financial advisor, that's okay. That's cool. But this forum is basically for education purposes, and we're going to keep it at that. So any opinions that I voice or somebody voices, and the reason that I go into detail, all that detail, is because we're going to look at stocks. We're going to look at charts. We're going to look at options plays and strategies. And so just understand where I'm coming from and where we're going. So that's the welcome message. The other thing on my agenda, we're going to talk about the options chain. We haven't talked about that in quite a while. That's because, why am I bringing this one up again? Because I see people that I don't know their experience necessarily. So I'm going to ask you questions just to kind of have an idea where you are, and that will guide me in terms of how deep, or how low, how high I will go on that. And then we'll try and talk about a good trade. We'll see what a good trade is. We'll see, what can we do in this market. We're going to try and analyze what's happening in the S&P 500, what's happening in some of these other stocks that we normally, work with. What's a good strategy, right? In short, we're going to be talking about buying low, selling high, and identifying what is buy. I mean, what is low, what is high, or selling high, buying back low. What does that mean? That's there are a couple of things that I have on my agenda. I think it's going to take me maybe 45 minutes to an hour to do that. But what are your thoughts? Does anybody have a hot topic that they would like discussed? All right, no. So you can, the window is not closed or the door is not closed on that subject. So if you have something that you really would like me to address, or people to talk about, go ahead and type in the chat. That's all right. I mean, you got an hour and a half to talk about it. One other thing about me, I am Eddie Gichuhi. That's how you say my last name. No, I am not French. I live in Atlanta, Georgia, and I trade options. I also teach options trading. So if you're interested in learning more about what I do, how I teach it, when I teach it, you can hit me up. My email, you go ahead and type that up, is info@options with Eddie. Let's see. Did I type that right? info@optionswitheddie.com, and the website obviously is optionswitheddie.com. Yep. So that is public. That is a link or an email that you can share with your friends, your neighbors, your buddy, your BFF, your bae, anybody. That is public information. You will see everything about the costs, the program, and all that good stuff. So I might mention that a little later on in this session. So any questions? Any questions so far?
I got one. I want to see, if you don't mind, I'm trying to get a better understanding of market structure.
Okay.
So like, I understand the higher highs and higher lows is, and then lower highs and lower lows. But what I'm not understanding is I can kind of pinpoint when I see that it's breaking down and going to the other direction. But at what point do we take out, for structure, when do we take out the other lows and it's no longer in, still a point for to say we're still bullish, I guess? Like if we were getting higher highs or higher lows, once we take off, like, and say we don't come back and make a higher high and just start ranging, at what point do we, when we take out that higher low, can we really say that we've changed direction, basically?
Okay, all right. So I'll bring up a simple chart. You might even recognize what this chart is for. So what you're referring to is, let's use this as an example. Can you see my screen over there, DeAndre?
Yes.
Okay, so when you're talking about higher highs, this is for the benefit of everyone. He's talking about, notice that the high of this candle, well, I'll start over here. The high of this candle here, this green candle, is right here, the top of the wick. That's the high. For reference, by the way, a candle has got 4 main areas that we are concerned about usually. It's got more than that, but we've got 4 main areas that we're concerned about. There's the open, the high, the low, and the close. You understand that when it opens high and closes lower, that's going to be a red candle, yes? Right? Because the price went down. But when it opens down and closes up, that's going to be a green candle. Makes sense. Perfect sense. At one point during that session, and by the way, one candle represents one session. And if you're looking at the daily candles, the daily time frame, then one candle is equals to one day. It's representing 1 day. So when we talk about higher highs, we're talking about this closing higher, this closing higher. Notice that the candles are closing higher, right? What happened here? We closed lower, right? Does that mean that we've stopped going up? Well, apparently not, because we start going up again, And Deandra's question is, how do we identify that we have stopped going up and started coming down? Deandra, did I get your question right?
Correct.
Okay, so we just look at the chat.
Well, it's like,
no, for real. So the way we are interested in higher highs and higher lows, we could be interested in 2 time frames. Now, when we're charting, we chart on the daily time frame. Right now, you're looking at the daily time frame. But most people, when they're talking about higher highs and higher lows, those are usually day traders, and they're usually on a time frame like 15 minutes, for instance. So over here on a 15-minute, I can see lower lows, and then I see a consolidation here. Consolidation here simply means that you're not going up above where you closed. You're not going below where you're closed. You're basically trading in a range until you reach a breakout point where you break out to the bottom. Higher highs and higher low trading is a very, very specific trading strategy, Deandre. I should say that, right? But I'll let you expand on your question. I think you had something to add.
I was saying more so like, as far as structure and knowing that, so like if you go back to the daily chart.
Yep.
Okay. So I'm gonna do the same area that you had. If this was our high, right?
Mm-hmm. Oops, sorry. Let me go back. I'm sorry. I clicked the wrong thing. Yeah.
So I'll just start from here.
Yep.
We're coming down, that's a low.
Mm-hmm.
So you see that, right?
Yep.
This is our high, low, lower high, 2 lower lows.
Mm-hmm.
And then we break this high.
Yep.
But then we still, so basically when you break that lower high,
mm-hmm.
would that not have turned us bullish? Because this is just an example for that area, but I'm trying to figure it out, not only the daily time frame, but the smaller, like you were saying.
Yeah.
But we broke that lower high, so that would be a change of structure or whatever, which, like I said, it would take us back bullish. Then we come back and break that low, pull back, lower low. These are pullbacks. See what I'm saying? Like this area.
Yeah, but you've gone too far. Let's stop at this structure over here for a second here. So the structure that you first drew over there, this W here, is actually called a double bottom, right? The bottom being down here at the valley. And from what we know is that usually the third time that we test that valley, we usually break to the bottom side. Okay.
So you wouldn't count that. You said both of those are together.
That is the double bottom. This is the first one over here, and this is the second one, right? And then this is the third one. What do? We break it.
Okay, and that's a retail pattern, right?
That's a what pattern?
A retail trader pattern, the double bottom, the W's.
I would say probably. I'm not familiar with the retail pattern there, but I do know about the double bottom and the double mountain top. So, all right, cool. So yeah, but if you're trading and you see these patterns, then be aware that every time we test an area thoroughly, we tend to break it, usually in the direction that we're testing it. So right now this is the daily, and the 15 is usually where a lot of people tend to look for those double mountain tops and the double bottoms, and then the inside there's a book, Deandre, you're familiar with the book, the Candlestick Bible, right? I think we've talked about it many times.
I read Candlestick Bible. I'm actually I got the Japanese one that I'm trying to start soon. So
cool. I'm going to refer you to that. You don't have to read all pages. It's maybe around 200 pages. A lot of it is pictures. It's an easy read.
Yeah, I actually read it in one day. So
all right, good deal. Any other questions?
Not at the moment.
Okay.
Thank you.
You're welcome. All right. Anybody else has a question or topic they want us to hit real quick?
Eddie, in reference to the candlesticks, we had discussed before looking at the 15-minute chart when we're day trading and which candlesticks to look for in reference to direction, or I guess that's the best way to put that.
So you're asking about a trading strategy using the 15-minute candle? Is that what you're asking?
Yes. If we're on a 15-minute, how would we know that? Are there certain candlesticks we should look for to indicate a change in direction?
I think there are. There are definitely some candlesticks that lend themselves well to day trading. So let's take a look at this 15-minute. And I wouldn't spend a whole lot of time on day trading because I don't like to teach day trading too much, especially to new traders, because that's a good way to lose money. It's also a good way to make money. So you have to be very, very risk tolerant in order to day trade. I firmly believe that swing trades actually makes more money in the long run than day trading. So even if you're day trading, you also need a swing trading strategy with you, because with day trading, you tend to make quick gains, get a little ahead of yourself, and give back some, and it's a bit stressful. But let's talk about this for a second. So when you are working or when you're trading during the day, so this is Friday, right? I'm just going to take one day at a time over here. This is Friday over here. I guess from here all the way to that is Friday. That's the time period we're going to consider. If you're on the 15-minute, how did things turn out? Notice we gapped down from where we closed the previous day, and then what happened? We, the second candle went all the way down, then came back up, kind of zigzagged a little bit. For a second, we thought we were going to close this gap, and then we turned all the way down. What would have been your strategy, Ali, if you were trading on 15 minutes? Would you have been confused about the direction?
I would have absolutely been confused.
And rightly so, because looking at this in hindsight, you're like, what did we even have market direction? Right? And the answer would have been, well, maybe not, right? But all indications in the morning were indicating that it was going to be a red day. How do we know that? Because we were looking at pre-market, we were looking at other things, we were looking at news, and also there was confirmation that we opened red, we opened down. Does that mean we stayed down all day long? Apparently not. So what I would say is you need a day trading strategy if you're going to day trade. So you have to be ready for a day like this one where it just zigzags or stays in a range. What if you had other information that helped you understand that we're going to be in a range? Yes, there is. There's some indicators that can help you with that strategy. Things that talk about anticipated volume, things that talk about range. You can also look at the options chain and identify what the implied volatility is for that particular expiration date. And then you can decide whether you're going to do an iron condor or a short butterfly or something like that. That would be the strategy for a rangy day. It's an advanced strategy. So that's something that I teach on Thursday nights, advanced strategies, how to take advantage of days like this one where you just simply don't know what the strategy is. So I would say from a 15-minute standpoint, this would be confirmation that range is simply we're just range bound. But if you're a day trader, you might even actually trade inside one or two candles. For example, on Friday, which is yesterday, I only traded this candle and I was done for the day. Right? Just this candle, I was done for the day. I had my conviction going into the market as the bell rang at 9:30. I believe I was in the trade by 9:32. By 9:35, I was out. Let me just confirm what my timings were. I think I posted in my group that I was out pretty early yesterday. Does anybody remember what I posted? Let's see. My transaction history there for the last 7 days.
Yeah, you got out at 9:50. You posted
9:50. 9:50. So I did. That's what time I posted it. My first trade, I actually did 2 trades yesterday. Oh, look at that. I was in at 9:30 and 43 seconds. So right as the bell rang, it took me 43 seconds to enter my trade. That particular trade, I held it for up until 9:32.22. I was up about $1,000 on this one. And then I entered another trade 9:36 and I was out at 9:43. So you can see my conviction here was pretty strong. At 9:43, the first candle hadn't even finished painting. So as a day trader, you have to have very, very specific strategies. As a swing trader, you also have to add another set of strategies. So to answer your question, who was that? Was that Ali?
Yes.
Yeah, that was Ali. Yeah. I would say that, these are advanced strategies that we talk about later on in the course. But as a rule of thumb, going in as a new trader, learning how to trade, you don't want to be in that business of getting in and out in those 15-minute candles. Instead, I would say, as you're learning, use the 15-minute candles to give you confirmation of direction. Right? Confirmation for direction. So let's look at want to look at something like Apple. Right. So Apple here is, let's go with the daily. So let's assume here that, and forget these lines. These are from a previous example I was doing, or previous trade I was doing. But how do you know that price is going to turn around? You've probably hit a support level, right? So obviously I hit this support level 150.77. That's what it looks like. And how do I know that it is price is going to turn around or going to continue going downwards? So on this particular day, what happened is that we actually opened at the 150, which was right at support. And for me to identify whether I should have bought a call or bought a put, the answer would have been to go down into a lower time frame, maybe the 15-minute. Let's see what happened here. So this is Friday. We opened downwards. First and foremost, that support level has been violated, right? So no business buying a call at that moment, because this first 15-minute candle is telling me that price went down, opened up and went down here, and continued going down. So that would have been my confirmation that even though we were sitting at support, and what do we do at support? We normally buy a call. We, because we believe that price is going to turn around and start going upwards. But we don't just blindly do that. Instead, what we do is wait for confirmation that price has actually changed direction. If it has not, for example, in this case, price did not, it continued going down, it means that we broke support. Right, we broke support. So that's how you know for sure that, or you use that 15-minute strategy. Basically, you are looking at the 15-minute candles to guide you. Can you go any lower? You can if you want to, but I think that information might confuse you, because I just went to the 5-minute, and I'm going to go again here to 9:30, which is right here. Well, 5-minute confirms it.
Yeah.
Yep, 5-minute does confirm it. Let's go even lower to see what would happen. 9:30 here would actually confuse you. You're right. The 1-minute candle would confuse, because you've got 3 red candles and then you have a green candle. Might that be a false positive there? Mm-hmm. Right? Because then you think, oh, price has turned around, and then what happens? It shoots right back down. So the lower the time frame, For example, the 1 minute and the 5 minute, I think that's too much data to make a decision for a swing trade. That's way too much data. It's false. So I would suggest that once you finish plotting on your daily time frame, and then in the morning, when you are entering your swing trade, go ahead and watch those 15-minute candles. Here's one more tip. If you're going to do a swing trade, don't buy it in the morning. Do not buy it in the morning. Why? At that time, you're paying premium. You're paying a lot of money for something that's going to be cheaper in about 1 hour, guaranteed. On Thursday, in my power morning class, we watched a particular strike to see how it plays out during the day. We saw that in about 1 hour, it had lost more than $10 in premium. In 1 hour, it had lost more than $10 in premium. Obviously, price wasn't going that direction. When price came back to that strike, I think I remember correctly, it was the 39.30 strike. Somebody correct me if I'm wrong here. It was a 39.30 strike. When price came back to 39.30, even the premium that we had seen 1 hour before had still decayed by at least $2 or $3, something like that. So would that have been a good decision to get in right when the market opened? The answer is no. So when you're doing a swing trade, and you might have heard people say, wait until the market settles, until it shows you its hand to see what direction it is going. That is what I would say as well. If you're doing a swing trade, go ahead and sleep in. Be like DeAndre. Wake up around 10 o'clock. Is he still here?
I don't wake up until college football come on. So
there we go. In college football, you're gonna have to wait a little bit, man. Now it's we're talking NFL.
I got another hour or two.
There you go. So yeah, Ali, there's your answer. If you're doing swing trades, don't buy in the morning. Don't buy in the morning. So
got it. Thank you very much.
You're welcome. Thanks for your question. Let's see who else. What
Speaking of 39.30, it's funny that you said that because and you said it Thursday. I was watching it Thursday.
39.30.
I watched it go down. I watched the call contract go all the way down to like $1, and then like the last 15 minutes of the day, it went all the way back up to about $18. Not 18. It was $1,800. So I watched it go from $1 premium back to $18. But it was crazy. I was like, dang, I should have bought that mug.
Yeah, it does happen. I've seen I have bought puts or calls, and for like $10-15, and then it starts going the other direction. I remember this one particular one actually cut the trade at my usual $2.50, and it went all the way down to 20 cents. I was like, this thing will never recover. 20 cents. It went from 20 cents back to where it was. I was, those are the days you question your stop losses, right? Those are the days I question my yes. So I question my stop losses a lot, but guess what? Stop losses save lives. They should have a bumper sticker for that. They ought to have that. Yeah, I think stop losses are very, very, very important. When they take you out, you should just celebrate. Maybe not so much, right? Not so much, but you should celebrate. The reason is they help you save money. They help you not lose more than whatever your stop loss was. So all this is part of risk management, which is important. It is much easier to recover from a defined stop loss than from an undefined loss. There's a difference. A defined stop loss is how much you said you were willing to risk for a particular trade. If you choose wisely, and you should, because you should know what the rules are for stop loss, and I will tell you in a second what they are, then that is the non-event. You can recover from that. But if you have an undefined stop loss, one where you're just in shock, you don't know what to do, you're crying, your tears dry. You're now like, I don't care. You throw up your hand. You're like, you call your neighbor and ask them what they would do, and they're like, I don't even do stocks, man. Sorry. Yeah. But what's a defined stop loss? Let's talk about that. A defined stop loss is first and foremost very subjective. It is subjective because it differs from trader to trader. My risk tolerance may not be the same as yours. What we have in common is that we don't like to lose money. That's the only thing, right? We both like to make money. So let's talk about what risk tolerance is. It should be relative to what the potential profit is. If I'm expecting to make $1,000 on a trade, would $100 risk be reasonable? No, let's see some answers here. Where's my chat?
No,
Where's my
especially
chat?
if it's SPX.
Especially if it's SPX. So
what if you got in at the bottom of your zone?
Right. So that's another angle there, that it is also dependent on. It's also depending on what you're trading, right? So if you put in a stop loss of $100 on SPX, you're basically saying, SPX, here's my money. Go ahead and take it. Buy yourself a cup of coffee. Don't you worry. Don't even give me a receipt, right? Because SPX is going to take that money in a heartbeat, less than a second.
Yeah, you have to have a super sniper entry for that.
Absolutely, right? Absolutely. So that's not reasonable. Would 250 be reasonable? Maybe. 150, maybe. We don't know. How about if it was on something like SPY, right? SPY is an ETF, and I put a stop loss of $100, then would that be reasonable? I think it is, right? And the reason I think it is because the options prices are, first and foremost, they are low, and also the movement is just as low. It doesn't move a whole lot. Let's see what SPY moves these days. It's got an ATR of 7.8. What?
Until this week.
Until this week, did it move a lot this week?
Yeah, it moved a lot this week.
Oh, okay, yeah, I see that. I see it dropped over here. Believe you me, at 3:30 p.m. yesterday, I was getting calls from people asking me whether it's going to go down to 378. I was like, 378? Where did you get 378? This one dude was telling me, I was going to 378. I said, yeah, I don't think so. Right. He was dreaming. I don't know what he was dreaming about. But anyway, yeah, Apple did move. It looks like it broke out. Obviously, it follows S&P. But let's get back to that stop loss thing. So we know that Apple, even though it has that ATR of 781, in order for you to lose $100, right? Say you had bought something at the money, Apple would need to move a whole another $2. It takes a long time for Apple to move $2.
That's SPY.
Maybe you're on SPY.
I'm on SPY, yes. Yep.
You're saying Apple.
Did I say Apple? Okay. Fruit company. Why am I thinking of a fruit company? No. SPY. So SPY. So SPY takes a long time to move $2. I said Apple? Yeah, probably did. What was I thinking? Yeah, I meant SPY. But even Apple, right? Maybe even Apple. Let's look at Apple. Apple 4.51. It also takes a long time to move $2. So in order for you to lose $100 on either Apple or SPY, it would have to move in the wrong direction by about $2. And this is kind of leading me into my discussion for today about the options chain. Why $2? Because the delta is about 55 or 50 at the money. Assuming that you bought these at the money, you know that delta is the rate of change of premium. And so for every $1 movement upwards, more specifically up, not down, then the premium should change by the amount of delta. And that theory should hold true when we go over to the puts, right? And we'll explain that a bit more. So that was about stop loss. Questions on that? Questions on that? All right. So now that we have that, the question now should be, where is this market going? And then we'll talk about the options chain. Peggy, you had a question? Or you might just went on.
No question.
Oh, okay. All right.
That's a question, Eddie.
Can you take that hot dog, put it in a plate for me, and just put 1 minute for 1 minute in my oven?
Yeah. Sorry, can I do what, Bob?
Oh, no. I'm sorry, I'm talking to my.
Oh, okay. All right. All right, Ali, you're up.
Oh, just quick, when you said the stop loss should be relative to the delta, is that what you're saying?
No, it should be relative to how much you were expecting in the reward.
Oh, okay.
But we have to consider how much that stock moves, right? So let's say that your risk tolerance is $100, $150. That if you buy something at the money, that's usually a delta 50, yes?
Okay, yes.
So we know that if the price of the underlying were to move $3 in the wrong direction, right? So wrong direction here means that if you had bought a call, price is falling instead of going up. Or if you bought a put, price is now increasing instead of decreasing. So if it moves by $3, then you've lost about 50 cents times 3, which is equivalent to about $50 times 3 in real money.
Okay.
Right. So if you had a stop loss of 150, that obviously stops you out in about $3 of movement for that underlying.
Gotcha.
Got me? All right. So you have to think in terms of, does that stock move a lot? If it doesn't move a lot, and you know that it takes it forever to move $2 or $3, then $1.50 stop loss would be reasonable, because it would mean that you're very, very wrong, or that's not the right direction, and so it should rightly take you out. Okay, but if you went to an underlying like S&P 500, you know that S&P 500 moves even $5 or $10 in about 20 seconds, 30 seconds sometimes, and so you can safely expect that if you put in a stop loss of just $1 or $1.50, it's going to stop you out. It moves a lot. Let me just demonstrate that here. So this is the S&P 500, and I'm just going to go to the 15-minute, or actually even the 1 minute, just to. I don't want that, do I? Hang on. Let me remove that background. There is a drawing set. Do that, then go back to the 1 minute. Am I on the 1 minute? Yes, I am. I'm on the one. No, this is the 5 minute. This is the 5 minute. Okay, well, I'll stick with the 5 minute. That's cool. No. I want to really the 1 minute. That's what I want. Okay, so on the 1 minute, notice that let's say you entered at this point, 38.63. I'm just going to use this for example. And you had a swing trade and went up. I'll do a price level here. Say you entered at 38.64, and at the top of this formation here, I'm just going to average right about there, 38.75. That's about $10, give or take, right? It's about $10.
Yeah. So,
Ali, let's talk about this $10 movement. If you stayed in that trade and you entered at 38.64, at 38.75, do you know how much you should have made if you had just bought one contract at the money? Even without knowing how much you paid for it, do you know about how much in profit you should be having at this point?
Not offhand, no.
Well, why not? Let's help you out. What's delta at the money?
50, right?
About 50, yes. Yeah, 50. And what is this movement representing? 38, let's just call it $10.
10, okay.
Yeah. So what's 10 times 50? 0.50.
5.
It's 5. So that's $5 in premium. You should have made that much in real money. How much is that?
$500.
$500 American.
Okay.
But if you stayed in the trade, if you stayed in the trade and it comes back down, you're now at break even probably, right?
Okay.
Well, how long did it take you to get to that 500 and come back down? Let's based on this chart, right? Based on this diagram that chart that we're looking at, I'm going to draw on the screen here. Let's say you entered at this point, went all the way up, did not get out, and then came all the way down. My question is, how long is it from here to here? What is the time?
And I'm looking at your.
Yep, 3 to there, right? About 15 minutes. So in that 15 minutes, if you did not have a good strategy to lock in your profit, you basically gave it all back. Right? You press it basically. So you need a strategy if you're trading S&P. But the point I wanted to show you here is if you had a stop loss, let's say you got in right here on the green candle as we are going up. This is way too much here. Let me see if I can zoom in. I feel as though I'm confusing you now. And I don't want to confuse. All right, so I'm going to zoom in on this particular section right here. Okay. And I'm going to delete everything here. So in here, if you bought it as it was going up on this red candle, is there a possibility if you had $100 stop loss, would this take you out? Right. So let's say you got in at 38.64 and this came back down here, it wouldn't take you out necessarily, right? Because it just comes back to 38.64. But on the rebound, once we hit that peak value over there and then come back, this candle will definitely take you out. Right, because it's 64 to 62. We only needed to go from 60. Yeah, that's $2 to take you out. And by the way, since this is 0 DTE, for instance, the premium is actually decaying very, very rapidly on the way down. So you don't even need that whole $2 because you've also got gamma. Are you familiar with gamma?
I am not.
All right, gamma is the rate of change of delta.
Okay.
Right, so that's another thing that we need to consider, that delta is not constant. Even though you bought it at delta 50, it is not constant because it's 50 when you bought it here. As it increased, that delta also increases. So when it's coming down, if you had a -1 stop loss, for instance, this hopefully this is going to make sense at some point. The stop loss could get triggered much faster than even when you were going up.
Because of the gamma.
Absolutely. Okay. So deeper discussion on that. We go into much more detail in the course about how to protect yourself and how to trade much better with S&P, with other stocks. We'll go into that. So questions on that. Questions on that. So is everybody familiar with the options chain? The options chain. This one. Is everybody familiar with everything that is over here on the options chain? Let me go ahead and add a few more things. I'm just going to do that. There's plenty of information here, but you can also add things like, there's a whole lot of things that you can add. I see a lot of people with intrinsic value, extrinsic value, volume, or not even volume, open interest. Let's start with that. Open interest. Right. It's good enough. Okay. Deborah says, Mary says no. Yolanda, yes. Fairly new. I can use help with that. Are you answering my question regarding the options chain? Is that what's happening?
I'm still trying to learn it myself, Eddie.
Okay.
And just familiarize myself with it. So I'm at the beginning stage.
Yeah.
Thank you.
You're welcome. You are welcome. All right. So let's choose. I'm gonna choose a fruit company. How about that? Let's see. Go 9 days. I'm gonna clear my drawing set. By the way, I'm using Think or Swim. If you're not familiar with this platform, it's made by TD Ameritrade. I don't work for them, but I think they have a pretty good product. But you can achieve what I'm doing here with pretty much anything. So, all right. So let's talk about the options chain, what you need to know about it, why it's important to know about it, and how do you use it when you're trading, right? That's a lot of words. Essentially, what we're trying to figure out is when you tell somebody you're doing options trading, they should be asking, how do you make money? How do you make $1 from this? Would that be a fair question to ask somebody who tells you that they do options trading? Yeah. I think it ought to be a fair question, right? When people ask you whether what you do and you tell them you're an options trader or you trade stocks, and they ask you what the heck is that, you should be able to tell them in a few minutes how you make $1. So the question is, do you know how to make $1 or do you know how to make $100? So I'm asking you now, do you know how to do that using options? So if you're silent, it means that that's a no. Not always.
I do, but
okay, yeah, all right. And DeAndre knows. All right. So for the new folk here, do you know how to make $100 using options? That's the question.
No, but I would like to know.
Okay.
I
like that. All right. Let's go with that one. We only need one. So let's think about this for a second. I want to make $100 using Apple, right? Apple shares. This ought to be easy for everybody. If I wanted to make $100 and I want to trade Apple, which has a ticker symbol AAPL, right now Apple is costing $150.70. For ease of math, let's just say it's costing $150. Yes. So 150, if I wanted to make $100 on Apple, I could buy 100 shares at 150. How much would that cost me? Somebody type in the chat, do the math for me.
15,000, right?
15,000 American, right? So $15,000 is how much it would cost me to buy 100 shares of Apple. And if I wanted to make $100, all I need is for Apple to move from 150 to 151 and then sell it. Yes? Easy math? So if I have $15,000 in bank and I want, not in the bank, in the brokerage account, and I want to buy 100 shares of Apple, I just did that. Can Apple move $1 in one day? Yeah, it can. Right? Can it also lose $1 in one day? The answer again is yes. But here we're being positive. We're thinking that we want to make 100. So the easiest way maybe is to buy 100 shares of Apple, or I could buy, 100 shares, spend 15,000, or I could buy 50 of them, right? If I don't have 15,000, I could buy 50 of them. How much would that cost me? It can cost me what, $7,500? Yep, $7,500. And this time Apple has to move $2 in order for me to make $100. You can see where I'm going with this. It's a lot of money. It's a lot of money to make just $100, right? Using shares. Now let's go back to options. We know that options are contracts. First and foremost, when I buy 100 shares, can I hold it for a long time? The answer should be yes. You can hold it for 6 months, 1 year. If it loses value a little bit, it's going to come back up. Apple has been around for a long time. It's a good, strong company. It's worth, a couple $1 trillion, if not more. And they make a good phone. Every once in a while they make a great phone. So that's a good thing. It's a good, strong company. It's not going to go out of business tomorrow. You can hold the shares. You can store your money there. When we go over to options, we have to understand that options represent leverage. So one options contract represents 100 shares of contract of Apple, right? Or the underlying. There's another new word there for you. Underlying. Underlying. When I say underlying, by the way, I'm referring to the ticker symbol AAPL, and this can be called many things. You can call it. Oh, what did I just do? It can be called the underlying. It can be called the security, the ticker, the symbol, the thingamajig. All of that thing. We are referring to Apple. That's what we're talking. When we say the underlying, that's what we are referring to. So options don't hold value for a very long time because they expire. They have an expiration date. So here's the first basic fundamental. There are different types of options. Actually, there's only two: calls, puts. Only two, right? When we think that price is going to be going up, what do? Do we buy a call or do we buy a put? So this is basic. This is fundamental. Yep. Seeing a couple right answers there. We buy a call. That's a good strategy. And what we're doing is we're saying it's almost like betting, but this is not betting anymore. This is control. This is professional, right? We're saying that, you know what? I think the price of Apple is going to go from 150 to 154. And so I am going to buy a contract that says that I have the right. I have the right, but not the obligation. I want to maybe hedge against the position. So I want to buy a contract that says that I have the right to buy one contract or 100 shares of Apple at a particular price. That price is called the strike price. So when you go buy a house, guess what? There's the base price of the house, right? So you go buy a $500,000 house, that is the price we're going to be negotiating on, that $500,000, that 500,000. And if you're not ready to buy it today, or there are things that need to be fixed about the house, then you have a letter, or you have some sort of contract with the owner of the house saying that I am going to buy this house at $500,000 if and only if these things are done. You need to fix that broken window. You need to make sure garage door is working, so on and so forth, and that kind of happens. And there has to be a time frame, right? There has to be a time frame for all these things. You can't just have an open-ended contract and say that this is going to go on forever, until the end of the year. No. There's a time frame. So, for instance, we might decide to write the contract today and say that this contract is good for 30 days. So this contract expires in 30 days, but the strike price does not change. You with me so far on this one? So between now and 30 days, maybe you pay to the homeowner a certain amount and say that I'm going to lock this price in. It doesn't matter whether the market goes up or the market goes down. So if the value of the house goes to, say, $600,000, right, goes to $600,000, then you're still going to buy it at how much?
$500.
At 500, right? Because the contract says 500. What if the value goes down to 400,000?
Still on the hook for 5.
You're still on the hook for 5, right? So that contract says 500. It's the strike price. It does not change. So when we go to the options chain and we pick a strike price, that price does not change. What changes is the price of the underlying. So there's two prices here involved. There's the contract price, we're going to call the strike price. And then there's the price of the underlying, which you're going to call the price of the house or the home or whatever it is that you're buying. Let me put a scenario to you. Let's say you decide you're the holder of this contract. You have the right, but not the obligation. You can tell the homeowner, you know what? no longer interested in this house. I know I can buy it for 500,000. Homeowner says, well, you have the right, but not the obligation. You can let it expire, in which case you will lose how much you paid for it, the premium that you paid for it. You guys are familiar with premium, right? So maybe it's not a down payment. It's just the right to execute that, right to exercise that option. So let's say, for instance, the value of that house increases to $650,000, but you're holding a contract that says you can buy it within 30 days for $500,000. And maybe you had your finances lined up, but you no longer have that. But your friend has the money, and you decide to sell him that contract that you're holding that says that you can buy the house for 500. Do you think you're going to sell it to him or her exactly how much you paid, or is the contract that you're holding worth more than it was at that time?
Say it's worth more.
It should be worth more, right? So let's give it a value. Let's say you bought the contract for $1,000, and now the house is worth $650,000. Is it possible that now your contract is worth $1,500? So you could sell it for $1,500, right? To your friend, and your friend would now acquire that right to buy the house at $500,000. Are we understanding now how options work? How those contracts work? So my thesis here would be that whatever it is that I am buying, the underlying is the price is going to increase, and therefore the value of my contract is going to increase with it. So far, so good?
Yes, is that kind of like wholesaling kind of related? Like, just in a sort of a sense, it's kind of put me in the mind of, selling a contract and making a profit off of that portion of it.
Right. So you're just trading the contract, not the house itself, not the product itself, right? That's exactly what we do when we are trading in the contract. That's what we're doing. We're just concerned with that contract and its premium, not necessarily those shares. It is very unlikely that as options traders, we're interested in buying 100 shares of Apple at $150. So let's do some things here. We're going to draw some lines. I'm going to draw the current price. Everybody familiar with what the current price of Apple is right now? Somebody type it in there for me, please.
150.70.
157 is great. So I'm just going to draw a line over here. I'm on Thinkorswim. All I did was use the price tool. I'm going to label this one as current price. We're now doing a real, example, something that is that we can actually take home with us as knowledge to use. So all I did was just draw a price line, a horizontal line, give it a precision of 150.70. Right. Hang on. So what did it? Oh, cool. Nothing fancy about that, right? All I did was just draw a line and call it the current price, right? Nothing to line over there. You're just drawing a line. This is plotting. The next thing I want to do is identify my support and my resistance. What does that mean? Support means that if this price were to drop, this 150.7, where would it stop? What is the likely place that it would stop, right? So we're talking about a buy zone here. We want to buy this. We want to buy. Where would it likely stop? Would it likely stop somewhere around here? Right?
Yep.
Yes.
Yep. Okay. So I'm going to say that it's going to likely stop at 146. And if this price were to go up on the other side, we're going to call that resistance, meaning that how high can it go before we get challenged? Would you say that, again, that point, the 164 is a likely place? Right? Why is it? I'm just looking for the peaks and the valleys, right? The top and the bottom. So there's many ways of plotting a chart. This happens to be, an easy way to find where the buy zone is and where the sell zone is. You might have you might have had it called in different ways and drawn a couple more lines. But the idea is that you're trying to find a buy zone and you're trying to find a sell zone. And we're going to do an example here on, I want to say we're going to buy a call. How about that? To make it easy, right? We're going to buy a call. We could also buy a put. Now, this would not be a perfect trade. And why is it not a perfect trade? If we bought a put, why is it not a perfect trade? Or not perfect, A+ trade? It's because the movement here is very, very small. We only talk about $4 difference here. And $4 difference to us, that's not exciting. That's we don't think that's great. So we're going to consider that this is not a good trade, but we're going to do it anyway, for example, just so that we can prove a point. Actually, let's go and do a put instead of a call, because I think it's more likely that price is going to go down than up. That's just me speaking. Again, don't take my advice. You need to wait for the market to open. So somebody do some math real quick for me. What is the difference between 140 and 146? I know what the answer is. Just type in the chat, blot it out, do whatever.
6.
150 and 146.
4.
Oh, I thought you said 140.
Yeah, 150 and
150.
Yeah, 150 and 146.
Yeah, you said 140.
I said 140.
Yeah,
Okay.
that's why I threw
Okay.
everybody off.
My bad. My bad. Yeah,
It's $4.
it's $4, right? Yeah. I just wanted to make sure you're listening, Tony. That's my.
I know.
You're paying attention. All right.
I am paying attention.
Awesome. All right. Yeah, what I really meant was 150 to 146, the difference between these two numbers, the current price and the target price. I'm going to call 146 the target. How about that? Right? The target. So the movement from the current price to the target price is $4. And today we're not going to talk about the, adjusting that by 60%, because this is actually a very, very small movement. It's not meeting our A+ trade, but I want to demonstrate a point. So we're expecting that price is going to move $4. If I were buying shares, if I had bought 100 shares and price moved from 150 to 146, I'd have lost 400. Is that right? The answer should be yes. If I had sold short 150 and bought back at 146, I would have gained $4. So you all hopefully you're all familiar with the concept of shorting and going long, right? So $4. But we're going to use options to take advantage of this drop, of this price movement from 150 to 146. We're going to use options. So what are we going to do? We're going to get some rules in place. First and foremost, we're going to go to the options chain, and we are going to find the strike that is greater than the current price. When we're buying a put, here's the rule. You choose a strike that is greater than the current price. And we're going to see that in a minute. Why? Because there's something called at the money, in the money, and out of the money. There's so many concepts here to do in about 30 minutes, but I'm going to mention each of them. We're going to buy the first contract that we have that is in the money, and that also has a delta of at least 50. So there's two things there. It's got to be in the money and has to have a delta of at least 50. How do we know it's in the money? Because it is going to be, the strike price is going to be greater than the current price because we're buying a put. Let's go over to the chain. Well, before we do that, we're going to buy time. You guys ever heard of buying time? So first thing we have to do is choose the number of days to expiration. My recommendation is 45 to 90 days. So we're going to first go to the options chain. The way I do that is by clicking on trade. And once I click on trade, I'm faced with all these dates over here. These are called expirations, right? Expirations. So you notice that the first one available to me is the 23 September, then 30 September, all that good stuff. You also notice that it has a number in parentheses behind it. What is that number? What does that number do? What does it mean? It's simply calculating for me that between today and 23 September, it's 6 days. So we can say that this is 6 DTE. DTE stands for days to expiration, right? Guess what? Guess how many days to expiration 30 September is? Anybody know? It's 13. October 7, it's 20 DTE, and so on and so forth. What are these things that are called weeklies? It just means that this expiration recurs every week. Is that the only recurrence that we can see? No, we can see that, or we know that sometimes some expirations actually recur every quarter or every month. So if you go to a ticker symbol like SPX, for instance, you're going to see that you have weekly expirations, you've got quarterly expirations, you've got AM, meaning in the morning. There's more to that. We'll talk about that later if we get a chance to it. So let's stick with Apple. Yeah, let's stick with Apple and see that we're first going to pick something that is 45 to 90 days. So I'm going to choose, actually, I'm going to choose 41. How about that? Right? 4 days between friends. Is that a big deal?
No.
Yeah, it's not a big deal. So I'm going to choose 41 days to expiration. So I'm going to choose October 28. All I do is click on that small arrow to the left of the date, and all of a sudden I've got a ton of information. By default, I don't remember how the option chain looks like by default, but this is a lot of data. This is way too much information. There's a lot of numbers. And I'm human, and I don't have that much patience to figure out all this information, right? Let me do something here. I've got some feedback. I've got some noise on. There we go. So all these numbers are supposed to help us do something, yes? Otherwise, they shouldn't be there. Do we understand all this? No. Oh, yes. All right. And if we don't, well, how do we figure out what we need and what we don't? The right thing to do is to understand what each of them does. And then from that, we can decide what we need and what we don't. So I'm going to pause that example that we're doing. Let's interrogate these options chain so that we can understand what we need, and then throw out everything else that we do not need. Is that a good idea? I think it's a great idea. So I'm going to start with, first and foremost, we decided that 28 October was the option, was the date that we're going to choose because it is 41. It kind of meets our criteria, but not really. But it's about 41 days. You might have heard somebody say you need, 60 to 90 days. So 45 to 90, as long as you are a long ways away. I do have specific rules about where it should be. But for this example, we're going to use October 28, which is 41 DTE. The next thing we're going to do, because we've decided we're going to buy a put, right? Guess what side the puts are? This side, right? These are the puts, okay? And these are the calls. No matter which program you go to, the puts will always be on the right side, and the calls will always be on the left side. Almost all programs, all brokerage programs that I have come across, that's the arrangement. You will also now notice that the strikes, that's the strikes right here, they are arranged going from lowest, and they go in incrementing fashion. Notice that they're going down, they're incrementing as they go down. Do you see that? They're increasing as they go in that direction. So 144, 145, and so on and so forth. Pretty simple. At first, to me, it was very, very confusing, but we'll try and demystify that. So the next thing that you notice is that there's a bit of shading right? There's a bit of shading, and I'm going to choose a different color now. Notice that there are some things that are actually shaded in, wrong tool. There are, on my program, these ones have purple. I think it's purple. Yeah, that's a purple shading on the put side, and on the call side, we also have that shading. What does that mean? Why are they different? What's the deal there? I think the deal here, or well, not I think, I know what the deal here is, that these are actually in the money, and I'm going to draw here. I'm going to label that for you guys, in the money. This is very, very fundamental, by the way. So if you already know this, forgive me for repeating myself here, but this is very basic. So this is considered in the money. We'll figure out what in the money means. This is also in the money for calls. So I'm just labeling it for you. In the money calls and in the money puts. Something you should recognize here immediately is that for something to be in the money when we're talking about calls, and we said these a few minutes ago, the strike price must be greater than the price of the underlying. What is the price of the underlying at the moment? It is a 150.7. So everything that is greater than 150.7 is what is in the money, right? That's what's in the money. So 152 is not actually in the money, even though it has a delta of 50, it is not in the money, right? 155 for sure is in the money. That's why now we need two criteria for determining which strike. So we say there's two things. Number one, the strike must be greater than the price of the underlying. Number two, the delta must be greater than 50. So to qualify or to decide which strike we want, then we're going to choose the 155 because one, the strike price is greater than 150, and the delta, I'm looking at this column over here, is actually 56. You see that? Your heads are nodding. That's a great thing. So let's also define what these are the things that are not shaded with a purple background or purple background. What are they? Right? These are out of the money. Sorry. Out of the money. Let me choose OTM and OTM. There's just one more acronym that we need to define, and that one is the one that is at the money. So I'm going to say that this one is ATM over there. ATM, at the money. So three things: at the money, in the money, out of the money. Deeper discussion on that. Why would I choose the 155 strike instead of the 160 or the 144? We'll see that in a second. So any questions on that before I go to further on that?
Yes, Eddie, I have a question.
Yeah.
Okay, so why didn't you choose the 152.5?
Because it is less
in the money.
Oh yeah, I could have chosen that because it is greater than 150, right?
Okay. Yeah.
Yeah, I could have chosen that. However, I have a specific reason I did not choose the 152.50, because I don't like decimals. It's as simple as that. It's a very subjective reason. I also suggest when you're picking a strike, choose one that is a whole number that does not have decimals. Does that answer your question, Suzette? Because otherwise it qualifies. It meets all criteria. It is greater than the strike price. Strike price is 150, and 152 is greater than 150. And it also has a delta of 50, which is the minimum, right? The only thing against it is that it is 0.5, 152.5. So I prefer, and you're going to have an easier time getting into and out of a trade that has a whole number, right? Tip of the day. You're going to have an easier time getting into a strike or a contract position that has a whole number, 155 150, 154, so on and so forth. But when you have a decimal in there, then people don't go out looking for decimal strikes. They don't do that. Okay, let's continue. Great. So now we know what's out of the money, what's at the money, what is in the money. We are always going to go for in the money or slightly in the money. What difference does it make? The difference, when you go deeper in the money, your potential for getting to your target faster exists. We're going to see how that happens. Let me pick on somebody over here. Donna, what's happening, Donna? Donna is awake. Donna's not yet awake. All right, let's go with Nadine.
Are you talking? I'm sorry. Good morning, Eddie. You're talking to me?
Well, Donna. Okay, Donna. I was talking to Donna but you opened your mouth. So
how you doing, sir? Good morning.
I'm doing well. You still on the West Coast, man?
Yes, sir. Yes, sir.
Awesome. That is good. What was my question? When I say buy low, you say
buy low. When you say buy low,
when I say buy low, you say
buy high.
Sell high.
Oh, sell high.
Oh, yeah. Killing me, man. You're killing me, Don.
It's early here. Yeah, I'm sorry.
Oh yeah. All right, you'll get the next question right, but somebody helped you out. When I say buy low, you say sell high.
Okay.
All right. Now, I'll give you a chance to redeem yourself over here, Donald. So for this 155 strike, how much will it cost me?
For 155 strike, it would cost you 155.
Well, you're looking at my screen, yes?
Yes, sir.
Okay, look at my screen. Tell me which column I should be concerned with to know how much this strike is going to cost me.
Okay, we at 155.
Yep, the 155 strike, it's a put. We're going to be buying a put.
Yes.
So how much is it going to cost me? Just one of them.
155, right?
No, not really. You want to call a friend?
Please.
All right, call a friend. Pick on someone.
Okay.
795.
Steven.
All right, Steven, you're up.
What
the 155 strike is going to cost me how much based on what you're looking at on my screen?
The 155 strike is going to cost $955.
955 is correct. And what did you look at?
That's 955 bucks.
Exactly. So
I looked at the ash column.
Yeah, nice. This is
Thank
nice.
you, sir.
Nice. So you're saved, man. You're safe.
It's early here. Forgive me.
That's okay. That's all right.
Thanks, Donald.
Maybe that's why I've been losing some trades. Huh?
I can see why.
Yeah. Thanks, Eddie.
I'm not gonna give you any love on that one. I can see why. So
all right, okay.
but it's a good learning experience over here. So
yeah,
I just shaded the ask column, and the purpose of that is because I want to see this 155 strike is going to cost us $9.55 in premium. Notice that I am looking at the ask column. Anytime that I want to buy anything, I'm always going to be clicking on the ask column. Whether it's a put or whether it's a call, it's always going to be the ask column. So let's think about that. $9.55 in premium. Remember, we say that one options contract represents 100 shares. And so this $9.55, is that really $9.55 or is it 955 cents? And why is it $955? Right? It's because we're multiplying that by 100. We're going to be multiplying a lot of things by 100. Does that make sense now? Why it's going to cost us 955?
Yes, because you're temporarily using 100 shares.
Absolutely. And we're still talking about one contract. So why are we so concerned with this? It's because my original question was buy low, sell high. What is our low? Our low is how much we're buying it for, which is $955. So far, so good. So far, so good, right? That's our low. So what's our high? How much are we going to sell this for? But let's first understand a couple of things. Let's work our way towards what that selling price is going to be. I am buying something for $955 in real money, or in premium, that is actually 9.55. In order for me to make money, should this increase or decrease? I'm talking about the premium, the $9.55. Should it go to $10? Should it go to $11? Should it go to $8? Tell me, what direction should it go?
It should go up.
It should go up, yeah. So from $9.55, I should be able to sell it for more than $9.55, yes?
Yep.
But that concept is also a little difficult to understand, because my thesis is that the underlying, which is now trading at 150.7, my thesis is that it is going to go down, right? So let's demystify what all of that is, right? We're talking about a put. When you buy a put, your thesis is that the price of the underlying is going to go down. But when you buy the premium for $9.55, that is going to go up. The only thing that should be going down is the price of the underlying. Let's look at the chart one more time here, right? Let's look at the charts here. We are saying that the price, and forgive all these drawings here, but we're saying that the price should go from 150 to 146. That is our thesis, and that is $4. So how do we take advantage of that $4? How do we make money from the price of Apple going from 150 to 146? The $4. How do we do that? Right? We're going to go back to the chain here, and we're going to buy the 155 strike. It's going to cost us $955. That is what we have seen. But the question now is, how much do we sell it for? How do we know how much to sell it for? How do we know how much to sell it for? Anybody have a good answer on that one? For those that are new or not in my class, maybe? Well, let me help you out. Let me help you out. So let's talk about delta, right? Delta here is, somebody type what the delta is. Just want to make sure everybody knows where to look for delta. How much is delta? Negative 56. Okay. All right. Negative 56. And what does that mean? Negative 56. When the price of the underlying increases by $1, right? When the price of the underlying increases by $1, then the premium, what is the premium here? $9.55. It should also increase by the amount of delta. So let's walk through that. If the price of the underlying goes from 150 to 151, then 9.55 should go from negative.
Doing the put. Are we doing the put already?
We're still on the put, but I'm going somewhere. I'm trying to show that the definition of delta is the same no matter whether we are on the call side or whether we are on the put side, right? So on the put side, it just happens to be negative 56 at this point. But if the price of the underlying goes up, then we should expect that the premium should increase by the amount of delta. So 955 plus minus 56 is what?
$8.99.
$8.99, right? So we just proved that if the price of Apple went in the wrong direction, delta still works, yes? Because what did we do? We just did 955 plus minus 56. What does a plus and a minus give us? It's like 5th grade math. Gives us a minus, right? Yolanda knows. Yolanda is right. It's minus, right? Now, let's go the right way. If the price of the underlying, which is 150, goes from 150 to 149, then the premium should decrease by the amount of delta. Is that right? So what's the new math? 955 minus minus 56. What's a minus and a minus? Positive.
Plus.
Yes. So that new answer would be 9.55 plus 0.56, and that should give us 10.11. Is everybody getting this? Is this starting to make sense why that
Sorry,
delta is?
Why did you do the minus minus?
Because the example here now is when the price of the underlying, which is 150, reduces by $1, then the premium should also reduce by the amount of delta, right? So 955 minus 56, because the delta is negative 56, yep? So let me write it down. Maybe that will make, let me give you a visual here. So 9.55 minus 0.56 is the same thing as 9.55 plus 0.56. Are those two equal to each other? Remember, minus makes positive. This is math that we learned a long time ago. I'm going to pause here for a second, make sure that it sinks in. But an easier way to do it would be that anytime that the price of the underlying reduces, then we're just going to add 56 to 55, 955. Is that right? Hopefully that's a yes.
Yes.
All right, great. So now that we have that taken care of, let's see, Suzette, you're on the spot here, Suzette, and you can call a friend if you get stuck. Okay. So Suzette, walk with me. Our thesis is that Apple, or the underlying, is going to decrease from 150 to 146. That's what we saw when we looked at the when we looked at the chart. Remember? Is that right?
Yes.
Okay. Let's go step by step. It goes from 150 to 149, and we bought this premium at 955. What is the value of my new premium? Remember that every time it goes in the correct direction, we're going to add 0.56 to our premium, right? So do the math, help me out. What is 955 plus 0.56? You got your calculator there?
Sorry,
with
10, yeah, 10, 11, sorry.
10, 11, all right. And then it's going to move again by $1. This time it's now 148. What is the value of my premium now?
So plus 0.56 again.
What is it now?
1067.
1067. And I could ask you this question over and over and over and over again. What is an easier way to do it if I knew that the total movement was $4? Could I do 4 times 0.56?
Yes.
And what would that give me?
4 is 224.
224. So if Apple moves from 150 to 146, and I had bought the contract at $9.55, could we safely assume that that 955 is no longer 955? Instead, it is 955 plus 2.24?
1179.
1179. 1179 is your high. So if you sell it, sorry, if you buy it at 955, you should sell it at 1179. So that 2.24 is how much in dollars, in real money?
224.
$224, right?
Dollars.
So we can see that your profit can also be calculated as delta times movement. What was the movement? $4. What was the delta? 0.56. And then you multiply by 100 to give you the real money equivalent, yes?
Yes.
Yeah, all right, piece of cake. So what are all these other numbers that we have? What's
Not
all
really. But
yeah, you know, all these other numbers that we have here, what are they exactly helping us to do? So let's look at them individually to see what they are, right? First and foremost, I've got the bid, the ask, the delta, the gamma, the theta, vega, intrinsic, extrinsic, and open interest. I'm going to go through each of them real fast. We've identified that the bid and the ask, first and foremost, when we are buying, we always click on the ask column. That should be ingrained in your mind forever. If we're going to sell, we're going to be clicking on the bid column. At this point, you don't know what to do with the sell, so we're not going to talk about it, but just know that that is when you sell. For now, only do the ask column. It's also called going long. So when we buy anything, we're going long. So this is called, we're going long on a put on Apple, 955. The delta, we have seen that it is that metric that helps us understand what our high is. We know what our low is. Our low was 9.55. Our high was 0.56 times the movement, which was 4, and gave us $2.24, which gave us an idea of how much to sell this for. And we're going to go through this whole example, you know, here in another second. Pop quiz here. Does delta remain the same throughout?
No.
Okay, delta does not remain the same, which means that every time that the price of the underlying, increases by $1, then the delta should do what?
Go up.
It should go up by the amount of gamma, right? So if the price of Apple increased from 150 to 151, then this delta would increase by the amount of gamma. What is negative 56 plus 0.2? 0.02.
0.54.
0.54. So we can see that the price went in the wrong direction and delta reduced. You see that? So that negative is very important to understand why it's negative. And it's a little confusing when we're talking on the put side rather than the call side. And I, purposely went on the put side because it's the one that gives people the most difficulty, right? On the call side, it's pretty easy. If I was buying a call, then if the price of underlying goes from 150 to 151, then my new delta is going to be 0.57, which is simply gamma plus delta, right? So that's what gamma is. Now, does gamma remain the same? Even though over here it says 0.02, 0.02, does gamma remain the same? Is it constant? Answer is no, right? Gamma is influenced by a metric or a Greek called Vega, which is expressed as a percentage. So we're getting deeper and deeper into all these Greeks over here about how each Greek influences the next Greek. So Vega, which is a percentage, it means that you could also describe it as a volatility metric. And depending on how volatile the market is, it goes up and down and it influences gamma. So gamma is not constant, neither is Vega, right? I did not bring in rho, which is also another Greek that you can bring in, but you can see there's all these things. I skipped over delta over theta, by the way. So let's talk about theta for a little bit here. If I were to hold this contract for many days, I have the potential to hold it for 41 days at the moment, right? Because it expires in 41 days. Is the 950, assuming that price did not change, assuming that price of Apple did not change, which would be very, very strange. Imagine the price of Apple remained at 150 today and tomorrow it's 150, the day after it's 150, that would be very, very strange. Price is always going up and down. So assuming that price did not change, what would be the value? The one that we bought it at 955 in 10 days, would it still be 955?
No.
No, it would have gone down a little bit, or would it have gone up? Down, right? Because it's decaying. It's decaying. By how much is it decaying? It's decaying, and I've got this covered over here by the amount of theta, and I think it's 0.09. It means that every day this contract would decay by the amount of theta. Let me give you a real world example. If you buy insurance on your car, say your car is worth however much, $50,000, right? And you insure your car for 6 months and you pay $1,000. I don't know how much cars cost. Cars cost that much? I don't know.
Now they do.
Now they do, right? What kind of car is a $50,000 car? I don't know. Anyway.
Yours.
No, I don't drive a $50,000 car. I don't even drive anywhere. I probably drive 10 miles a week. Starbucks is not that far from my house. And I don't need a $50,000 car to go buy a Starbucks. That's the definition of dumb. Yeah, I'd rather walk there. So anyhow, if you insure your car, however much it's worth, that is the strike price. Its value is the strike price, right? But you pay a premium. Let's say you pay $1,000 to your insurance company, and they're saying that if you run into a deer, no, we'd never run into a deer. Maybe a deer ran into you. Let's call it that way. By the way, if you ever, hit a deer on the road and the insurance company, you're trying to explain, never say you hit a deer. Tip to the wise away. You don't know the deer hit you. All right. Because now it's the deer's fault, not your fault. They don't teach this in school. The deer hit you, right? So you say you got hit by a deer. The insurance company says, your policy is still good. We're gonna replace that, whatever. But what if that never happened? You never had any peril, right? That's an insurance term, for accident or something. You never had anything go wrong. And 2 months down the road, you're like, you call the insurance company, dude, man, I'm a really safe driver. Nothing ever happens. The $1,000 that I paid you guys 2 months ago, you guys need to give it back to me. Will they give it back to you?
No.
Why not? Nothing happened.
That's what insurance is, just to cover you in case something happens.
Right? But nothing happened.
Okay.
What has happened is time has passed. That's the only thing that has happened, right?
Right.
So your $1,000 premium is no longer worth $1,000. It is worth less because you've been fully covered for 2 months.
Mm-hmm.
Your premium is now worth the remainder of the term. And if you wanted to cancel the premium, the policy, then the insurance company rightly should simply just give you a prorated refund. So you see how that 1,000 on day one was worth 1,000. 60 days into the policy, it's no longer worth 1,000. It's decayed to now maybe 4/6 or of the 2/3 of the time, right? So theta is the same thing here. When we come back here now to stocks, what you paid on day one, the value of the contract, which was how much? $9.55, decays every day by a certain amount. And so at the end of that contract, at the end of 41 days, guess how much? Even if price did not move, the value of your contract would be worth how much? 0, right? Because it's decayed all the way to 0, right? It decays a little bit every day. The further out you buy the contract, not much decay, but the closer you go towards the expiration, it decays much faster. So 2 weeks out, not so much. 7 days, much faster. 0 DTE, it's very aggressive. It must decay all the way to 0. And by the way, if the price ends above your strike, then you have something called intrinsic value. Intrinsic value does not decay. The only thing that decays is extrinsic value. Extrinsic value must go down to 0. Extrinsic value must decay all the way to 0. Extrinsic value does not. So in fact, let's look at those columns here. I'm going to look at extrinsic value and intrinsic value. Notice that anything that is out of the money has got how much intrinsic value? Zero, nada, nothing, right? It's out of the money. How about extrinsic value? It is composed of entirely extrinsic value. So it's to your advantage to buy something that has value. And that's why we go slightly in the money or I mean, at the money or slightly in the money or deeper in the money, whatever. We avoid out of the money contracts. So you can see there's so much data over here that I really don't need. So guess what I will do, right? Guess what I will do to make life a little easier. I'm simply going to go to my layout and I am going to customize. I'm going to remove everything that I do not need. I do not need to know how many people own this contract. That's what open interest is all about. I don't need to know the extrinsic value. I don't need to know the intrinsic, the Vega, the Theta, the Gamma. I don't need all of that. The only thing that I need is Delta. I'm going to push OK. Now look at my screen. Is it much cleaner? Is it much cleaner? That's all I need to make a decision. The only thing that I need to make a decision to help me out is the strike, the ask, and the delta. All that just, but we had to go there, didn't we? Right? So when you clean up your screen, when you go over to your brokerage platform, whether it's Thinkorswim or TradeStation or Webull or all that, the only three things that you need at the moment are the strikes, the ask price, and the delta. So let's finish our example over here so that we can move on to something else. The example that we wanted to do was to build that trade and see how do we actually put it inside the platform, because we've talked about it in theory. How do we do it practically? Would that be a good thing? Let's do it. Let's make it happen. So we decided that we are going to buy the 155 strike. It's a put. We're going to spend, right, $9.55. How do we do that? We just click on the ask price. It's as simple as that. It's not complicated. I just clicked on the ask price. Now, this would be the simplest way to do it. And then I just have to now watch this trade. And once it reaches around $11.79, then I would click on sell. But is that a good idea to just let it be, right? I'm of the idea that we need to calculate what our take profit is and also decide what the stop loss should be. So there's a better way to do it. I'm going to delete these. The better way to do it is to right click on this ask column. And I'm going to choose buy custom. And I'm going to choose with OCO bracket in that order, buy custom and then with OCO order. What did I just do now? I created 3 orders. Notice that I am buying one, that's a line in green. Plus means that I'm buying, minus means that I'm selling. Why do I have 2 of them? It's because one of them is a take profit and the other one is a stop. Okay, by default, Thinkorswim wants to give me $1 in profit, but I know better than that. We calculated what our exit price is going to be. Remember, we said we understood what the low is, and we calculated what our high is. Remember, buy low, sell high, donut? Yep.
Yes,
so,
sir.
All right. What was the high? We calculated the high to be 9.55 plus $2.24.
1174.
1170. Let's try that again. 1179. All right, 11.79. So we know that, or rather, we're figuring out that the 155 strike put, if we buy it at 955, we want to sell it at 1179. Right, 1179. Now I like whole numbers. I like whole numbers. So you can put 1180 if you like, or you can put 1175. It's up to you. But I like whole numbers. Now the question here is, we're going to spend $955. We are potentially going to gain $2.25 or $225. What would be a good stop loss? And how do we define what that number should be? So this is subjective. So let's go with what Thinkorswim gives us by default. By default, it subtracts $1 from the premium that you're paying and says, we're going to protect you with $1. So if the premium went from $9.55 to $8.55, how much will you have lost at that point? $1 in premium. $1 in premium is equal to how much in real money?
100.
It's 100. Okay, so we'll go with that. So 100. So now if I click on a confirm and send, let's see what the situation looks like. We've got 3 orders in play here. We've got buy 1 apple at $9.55. This is the line that I'm looking at. You can see my cursor right here. Order number 2 is a sell. What am I doing? I'm selling the 155 put at 11.50. Basically, I'm making $2.25. This is a trigger. And the third one is also a contingent order. This is my stop loss. So we can see that we placed an order. We also sent another order that is contingent on the first one happening. And we protected ourselves from the downside. I'm going to push send and let's look at it in another way. So what happened? It just disappeared from my screen. Where did it go? Right? Where did it go? Well, it went to the monitor tab. So now in the monitor tab under activity and positions, I can see my working orders. Everybody know what working orders are? Hasn't happened yet. Has not happened yet. It's like going to Chick-fil-A and the young dude over there asks you what you want and you tell them what you want and they say my pleasure. And now you're waiting in line. By the time you get to the order, they're working on it. It's a weird example, right? Yikes. I should have used Starbucks. You're on the drive-through and you ordered a caramel macchiato. By the time, or the difference in time between where you order and when you get to the window, it's in working status. Walk with me here, man. Let me see. Walt, Mr. Walt, what do you think? Good idea?
Yes, it's a good idea, and you're making me hungry at the same time.
Yeah, I know, but you perfectly understand that scenario. That's
yes,
that's what that working orders. Now, guess what? Once you pick up your macchiato, where is it going to be?
Field orders.
It's going to be in the field orders, yeah. Yeah.
Yes, sir.
Yeah. What if you cancel the order? What do you think now? It's going to be in the canceled orders.
Yeah, cancel order section.
Cancel orders, right? So it's as simple as that. It's not complicated. It's not complicated. When you look at this, just read the labels. They should be simple enough to help you understand what's happening. So let's look at this one a little bit more. This one has not happened. And notice also on the left side, it's got a key. It's kind of like a primary key. For those of you in IT, you understand what primary means. And then you notice that these 2 orders are linked, right? These 2 orders are linked. So in English, we say that they are mutually exclusive, meaning that if one happens, the other one is going to be canceled, right? That's what that means. So why do we have 2 orders here and not just one? It's because one of them is our take profit. Notice that the opening one says position effect is to open the trade. This is now a tutorial on Thinkorswim and how you should be looking at your orders. That one says to open, right? And this one is to close. We have 2 of them to close. The first one, and it can be in any order, by the way, they're not necessarily one on top of the other, but this one is to sell. This is your stop loss, because it says stop, STP, market. If the price fell by $1, then it would stop your order. This other one is your take profit order. It's a sell to close. That's why there's the -1 there. And it would sell it once the price has increased by $2.25. No math required. It's going to do it for you. All of this thing is called a bracket order. You can see how easy it is to automate your orders, right? You can go to sleep knowing that the most that you can lose is $1. The most you can gain in this particular case is $2.25. Questions on this one? Questions on these? So the reason I went through all of this trouble is because I see a lot of new people, and I'm not sure where your standing is with options on how to, or how to use this, but there's a lot more in terms of how to read these. Most importantly, it is how to enter the trade, what to click on, and how to build that as a bracket order. I always recommend that you put your orders in as a bracket, because you're telling the system where you want to get out. Here's another tip for you, by the way. Where you exit is more important than where you enter. So if you think in terms of where you're going to, basically your exit plan, where are you going to be exiting? And that exit is going to be, whether you're making money or losing money, and you've defined both those places. It's no longer guesswork, right? You've taken out the emotion, you've taken out all emotion of, deciding once you're inside the trade, there's no more emotion about, should I get in, should I get out, should I do, should I do this, should I do that? I think at the beginning of this call, somebody had a question about this same thing. I think it was Apple. They were asking, should I get out? And obviously, that was you, right? But you can see with a bracket order, you no longer have to make that decision. You've already made the decision up front, right? If the trade is good, it's going to go on and get you the profit. If the trade is not good, it's going to go ahead and take you out with a stop loss. And it doesn't mean that that's a bad trade. It just means that at the time that you made the decision, you were doing it based on the information that you had. So it wasn't wrong, but you were protecting yourself, kind of like insurance, and say that, you know what, $1,000, if things never happen, well and good. If something happens, I'm covered. Yeah. So now, was this an A+ trade? The answer is no. It was not an A+ trade, right? Why is it not an A+ trade? Because the distance between the current price and the target price is too small. In my class, we don't trade for less than $300 to $500. So this was definitely not a good trade. But at least it took you through the steps of how to build a trade. Yeah. So you need to come over and understand what is a perfect trade. What are the other things that we look for when we look for an A+ trade? Let's see, Walt. What's your question, Walt?
Yeah, I was wondering, like, is there still the 3-to-1 reward type of trade, or does the delta and changes all that to where you're kind of trading on time rather than a day trade type of 3-to-1? So
Yep. That definitely exists. Risk to reward. It's not necessarily 3-to-1, but when we talk about an A+ trade, which I did not talk about today, then that comes into play where you decide, in order for it to be an A+ trade, you've got to have a reward that makes it worth even putting out the position. Because we're going to come across many trades. You can do this trade, 2-3 times a day. Does it make it a good trade? No. So I teach how to build an A+ trade, what risk reward ratio is acceptable when it comes to options, and how to figure out what that risk ought to be. Okay, so 3-to-1, I know where you're coming from. You're thinking about stocks, and you're thinking that your profit is $300, so your risk is 100, and so on and so forth, and that's valid. That's okay, right? But now, when we're talking options, that whole dimension is no longer there. By the way, let me remind you guys, when we were trying to make $100, how much did we need using stocks if we were going to buy 100 of them? $15,000. $15,000, right? And that was dependent on the price of Apple increasing, right? Well, it could have decreased anyway, but And now in this trade using options, we spent how much? $955. And we made twice the $100 target. Right? How many days does it take Apple to move $4? Could
One day.
It could move one day, right? So we could potentially make that $200 in a day. But this is not a good trade. This is not an A+ trade. We talk about A+ trades much more deeply in our class. So good question over there, Walter. Was that Walter? No, Walt. Sorry, Walt. Yolanda, what's your question there?
My question is, if your trade is in the profit, this one that you just did, and if I wanted to move my stop loss, would I have to cancel and put it back in, or can I just move it down so that I don't lose the
You
profit?
can move it. You can move it.
So I can move it without canceling it.
It would be a cancel replace.
Okay.
So moving it is the equivalent to doing a cancel replace. So some people ask, can you move these things? Can you actually move these? What did I just do?
No, the stop.
Yeah, the stop. Yeah, can you move these? And the answer is yes. How would I be able to move that? You'd have to go into the options chat to be able to move that. So let's go to, that was a 155 strike. I'm going to just do some fancy things over here. And I'm going to send these to Blue. Don't ask me what that is. You can ask if you want to, actually. And now I'm looking at the chat for that particular option. Notice that I think your question here, Yolanda, is I want to move this stop limit here from this point. All I have to do is just click on it and drag it to where I want.
Okay.
And then I get this confirmation dialog, confirm and send. Notice that I have moved my stop. Hang on a quick second here. All right, sorry about that. And I'm back. Okay, so who was that? That was Yolanda, right? So Yolanda, you can see how actually I moved the wrong thing because that was my limit, right?
Right.
Yeah, I moved the wrong thing. I just realized that. Let me move it back. I'm just going to move it back over here. How about that?
Okay.
And I'm going to confirm and send. The stop is the one that I wanted to move, right?
Right.
So I can just move it up and down. I can move anything. I mean, I'm in control, right? Even my entry, I don't have to be stuck over there. Maybe I want to over there. See that?
Okay, now the way you move the entry, you can only do that if your order hasn't been picked up, right?
Affirmative, yes.
Okay. All right.
Yep, but once you're inside the trade, then you still have these two to play with.
Okay.
Right? Your take profit and your stop.
And you can move them independently. Since you did the bracket order all at once, you don't have to move those all at once.
Yep. I mean, just look at that. I want to move my stop down here. I can do that independent of these other two.
Okay.
Yeah. It's as easy as that.
Excellent. Another question. On the options chain, you pick 955. Do you yourself go for the ask price, or do you go kind of like in the middle between the ask?
So when I clicked on the ask price on the 155 strike, that is the median, right? So 955 is that's the natural.
Yeah, that's
that is the natural, and you could go for the median. I don't usually pay premium. I will try to go for the 945 if I can.
Okay.
I like to negotiate. I don't like to pay MSRP, full price.
Okay.
Yeah. So yeah, if you can negotiate, by all means do it.
Okay.
In fact, because you know that the market is offering between 930 and 955, guess what? I might even put in a bid for $9.30.
Because it's a whole number.
Yeah, it's not only a whole number, but I know in the market somebody wants to sell it at 935, at 930.
30, yeah.
Yeah. So you're not stuck on this. Now, if you wanted to buy it like right now, immediately, pronto, this moment, 955 will get you in.
Right.
Even 9:45 will get you in, right? But if you go to the chart over here and go to the 15-minute, remember we talked about the 15-minute to see confirmation and all that.
Right.
Then we know that, you know, with the ebb and flow, with the back and forth, you will get that $9.30. You don't have to pay premium for it.
Right. You just have to wait for it.
Absolutely. Yes.
Okay. Thank you.
So yeah, negotiating is always a good thing.
Mm.
Yep.
Thank you.
You're welcome. All right, guys. So that was a quick primer on that, you know, options. We understood here that in order for us to make money here, we're using leverage, right? We know that we have certain minimums that we have to make. Today, we did not do an A+ trade. We talk about an A+ trade a little later on, but you have the fundamentals that we buy low, we sell high. The question was, when we buy low, what is that low? We're not actually paying $150 for these. We're actually trading the options contract, right? So, and we understood that in order for us to select what contract we're going to buy, we first had to pick the days to expiration. We know that a good days to expiration would be 45 to 90 days. Once we entered that 45 to 90 days, we then decided that because we're going to do a put, we're going to choose a strike that is greater than the current price and has a delta of at least 50, right? If we were to buy a call, we would have chosen a strike that is less than the current price, that has a delta of at least 50 as well. So 150 would have been a good choice if we're going to do a call. We also decided that we're going to avoid, there's nothing wrong with it, but we're going to avoid all those strikes that have a decimal in them. So 152.50, not good, right? Does it mean that we cannot trade this? We can. Do we want to? No. So it's very subjective, right? This is Eddie saying, don't do it. Then we also understood that once we bought it, we had to think of where are we going to sell it? Well, how do we figure out how much we're going to sell it for? We figured that by taking the expected movement in this particular case was from 150 to 146. We found that there's $4 in there. And so that every time the price of the underlying decreased by $1, then we were going to gain 56 cents in premium. We calculated that, and the net was $2.25, give or take. We also understood that delta is not constant, but we don't care at this point. We're just doing a straight line calculation. No need to complicate this. We just did delta times the movement. And we found it to be $2.24, $2.25, give or take. That is also equivalent to our profit. So you can see how we can use these numbers to help us make a decision. We also saw that there's so many columns that we can add over here. We can add 1,000 columns. Well, maybe not literally 1,000, but we can add so many of these, just scrolling up and down over here, these possibilities of available items. But none of these help us make a decision that will alter the path, right? It's just additional information. At this point of time in your learning, you don't need it. Maybe later on when you get into an advanced strategy, you might decide to go for a gamma play, or you might go for a Vega play or something like that. But at this point, practice on just the simple calls and puts and use delta. That's your most basic metric that is going to help you with this trading. It is going to help you for a very, very, very long time. Right. Mary is asking, for your order to be executed, it depends on how fast your stock moves. Not necessarily. The reason for my answer of not necessarily is because when you build your watch list, Mary, when you build your watch list, you had to have met some certain criteria. Yeah. There's some certain criteria. What was that criteria? Things that move $1 million, things that are worth a certain amount of bucks, things that have a certain ATR. So for it to be on your watch list, you need to pre-qualify it so that you no longer care about open interest and volume and so on and so forth. You've already pre-qualified it as tradable for you. right? So my answer to your question is not necessarily. So was that a good summary? What did I miss? What did I miss?
Market money maker. Is that what it's called?
The MMM. So Maureen is referring to what is this little thing over here in yellow, right? So this metric over here, the MMM, is that what you're talking about, Maureen?
Yeah. Mm-hmm.
Okay. So Thinkorswim has got this feature that tells me approximately how many more dollars or how many more points this price is going to move on an expiration basis. So it is not telling me that the 28 October strike is going to move plus or minus $2. It is referring to the current trading day expiration. So this MMM is very, very specific to not even the 23 September, but whatever business day Monday is going to be. Was it September, today 17th, 18th? So on the 19th, we expect that Apple, right, the underlying here is going to move plus or minus 2.963. It could be up, it could be down. That is not a definite hard number, right? That's just for those that do machine learning and AI, that's just a statistic that tells you the probability. Another metric to consider is the implied volatility, right? The implied volatility, if you notice my mouse over here on the right side, I'm mousing over this metric here, plus or minus 6.6. It's implied volatility. You see that, everyone? That tells me that this underlying has the potential to move plus or 6. So you can already see there's a discrepancy there between the implied volatility and what the market maker thinks. But those two are going to mesh at some point during the day on Monday. This implied volatility is not to be confused with the volatility index called VIX. Deeper discussion. So there's plenty of that discussion to go around when you're talking about how much do we think a particular stock is going to move. All of that comes into play when we talk about what our A+ trade is. We're going to be considering how much potential, how do we increase our probability of success? Because that's what it boils down to. You can make any trade you want. Does it mean it's the right trade? Answer is no. You need to increase your probability of success by adding other things, other tips, the tips and tricks that I will show you along your trading journey. So good question on that, Maury. Thanks. Okay. I don't see any other questions. Let me look at the chat here.
So the delta and VIX is two different type of indicators of volatility, right?
Yep. And I don't even look at the VIX so much. So the delta is a lot more important than the VIX.
Very helpful information.
Okay.
Thank you.
Cool. You driving today? No, you're not driving today, are you?
No, I'm just out and about today. I'm not driving now, though.
What do you normally drive?
I drive a GMC pickup truck.
Okay. Hot shot?
Huh?
I thought you do truck driving. That's why I was asking. I wasn't.
I'm getting ready to start luxury tour bus driving.
Okay.
Just put
all right.
Application and nice. Just checking off another childhood dream. But I tell them all that, hey, stock market is a childhood dream as well. So
yeah,
I'm trying to figure out how I can replace the income. Profits is better than wages, And
you betcha, luxury bus driving. Yeah, that's a good deal.
Yeah.
Awesome.
Thanks.
Awesome. You're welcome. Donna, do you have a question?
Yes, since we spoke, I did have a cup of coffee, and I have waken up since then. I just want to share with the students and the students to be. I have been very successful. I am one of Eddie's students, and I was not trading options until actually taking his course. And he has a really outstanding program, which is option trading plan, and you follow those steps through, you will make money. You know, in the business that we are in, yeah, you will have losing trades, but the most thing that I learned from Eddie is that when you trade in and get consistent profits in your trades, you can't become a millionaire overnight. In time and place, just follow the plan. It will, you will be successful. And I just want to share that with the students. And thank you, Stephen, for bailing me out there. I just hadn't woken up at the time. And of course, the strike price and the asking price, you need to make sure you understand the difference. So I just want to share that with the students. Thank you, Eddie.
Awesome. Thank you. Thank you for that plug. Yes, Donald has, and that's only this year that we've gone through. The program is 8 weeks. It doesn't mean that the relationship ends in 8 weeks. It just means that we finished what we want to cover in about that time. It's a weekly program, so we meet by Zoom for at least 1 hour. Sometimes I talk too much, so sometimes we go like 90 minutes or so. But it's a very structured program. It's improved over time. It's also results based. I like to see results. I'm the kind of guy that will quiz you a lot. Now, you're not going to fail. I haven't had any failures yet. It's almost impossible. I think it's impossible to fail, but we do expect results. And because this is not a hobby, this is a life-changing skill. Yeah, and a lot of practice involved in everything that we teach. So we do follow some rigorous methods. There's a lot of structure. There's make sure that fundamentals are, well understood. You're going to spend a lot of time in fundamentals before we speed up, but it's necessary, because if you're fighting with the fundamentals, then that's the difference between, that's the barrier between what you want and where you are. So if the faster that we can get rid of the fundamentals and understand them and even get the program out of the way, I'm talking about the platform. If we can get that out of the way, then that would be the way to go. So thanks for that, Donald.
Yes, sir. Anytime.
Absolutely. Do I teach gaps? Yes, I do teach gaps. Gaps, I will teach you gaps. I don't spend a whole lot of time, but gaps are very, very, very important, by the way. Even in our trading, we spend a lot of time playing the gap on SPX and other things like that. So I think I have a few students who don't do anything else apart from trade options with gaps or trade gaps with options. Thanks for that question there, Yolanda. Any other questions before we hang up? I am going to stop sharing my screen. Am I still sharing my screen? And feel free now to turn on your cameras on.
Can you share your is it optionswitheddie.com?
The website? Yes.
Yes, okay. I just want to make sure I had it correct.
Yep, optionswitheddie.com. So options, let me type it in again here. As a matter of fact, let me just go over to the website. Make sure we get the. Here we go, optionswitheddie.com. So you are.
That website will give us more information on more
Yep.
detail.
Absolutely. Yeah, it's going to take about 2 hours to read.
Okay. Thanks a lot.
Come on, take it. Yeah, don't go there if you don't have time. Yeah, just kidding. 2 minutes.
I know it. I know it.
Yeah. you know me. I like humor. Humor is part of my it's part of my repertoire over there. So cool.
That's a great thing. Thank you.
Awesome.
Eddie, I just want to say again, thank you. I was lost, and you guys can see from his training today that he takes his time and he breaks it down to a way where you can understand it. I've been out of school a long time, so the patience that this man has is incredible. And if you stick to it, every trade's not going to be a winning trade, but if you stick to the rules and what he's teaching you and apply it, most of them will be good trades. So Eddie, thanks again for all that you're doing, and I just want to tell you all that it's worth it.
Awesome. Thanks for the kudos there. So my class is not cheap. It is not expensive either. Most of my students will make their money back before the class is over. And that's the objective. Teach you how to make money consistently. Even if it's just a few $100s, that's what we're all looking for. But yeah, cool. Thanks so much. Well, I don't have anything else to tell you guys. We're going to meet in a couple of weeks. So hit me up. If you're on the fence about joining my program, go to Options with Eddie, set up about 20 minutes with me. It's not a coaching call. It's just a discovery meeting. And I think I've already sold you, so I'm not going to be trying to sell you. Instead, you're going to be trying to tell me or ask me whether it's worth it for you. So sounds good, everyone.
I have a question. The consultant call, that's not what you're talking about, right?
The quick meeting that is on the website, that's just 20 minutes, 15, 20 minutes, just discovery call. Some people on the fence, they might want a bit more information. That's what that is for. If
Okay.
you're talking about a consultation, that's different. And that one does cost money, yes.
Okay. And how much time is that? When I saw that out there, how much time is it?
How much time is what?
The consultation call. What's
Oh, that would be about 75 minutes, give or take.
Okay.
Yeah. Yeah. Sometimes a little less, sometimes a little bit more. Usually it is, we're solving a particular problem, right? So I get consultation calls even from people who have been trading for a while, and maybe there's just a concept that they want to clear up, or a strategy, or something that we can go deeper into without getting into, or maybe it's more personal to their style, their trading strategy or something like that. And by the way, my classes have a cap of 10 students, right? 10 students at most. We never go more than 10, the same 10 every class. So I have a few classes every week. I think the next one is slated for October the 3rd. That's a Monday. And once that one fills up, then I just go on to the next one. So it's a maximum of 10 students per class. That allows me to get in depth. It allows me to get to know the students. They get to know me. We identify. It used to be one-to-one, but now it's at least no more than 10. So does that help you, Sharmina?
It does. I think I don't know if this is something for everybody, but the question, because like now I'm in Terry's class, I'm at very bare bones, basic, gathering that knowledge. And I did take your advice and I set up the TD Trade account. So I have that set up. I started watching some YouTubes on Think and Swim. Of course, today was very helpful as well, but I still haven't just gone in the sim and jumped out there yet, because I'm always multitasking as I'm doing these things. So based on kind of what I'm hearing from you today, it still may be beneficial to me to do some more fundamentals on that side first.
It's really up to you. When you come to me, it is independent of where you're coming from, right? So you might have gone to that class or gone to another class. It really doesn't matter to me. But when you come to me, there's also going to be some unlearning, right? You're going to be unlearning some of the things, right? That you may have picked up in other classes. I'll give you a couple examples. You don't need a million lines to tell you what to do, right? You don't need a million lines. You need just what you need to see, and you need to sift everything else out. You also need to understand what the rest of the industry works, how the rest of the industry works. So when I talk about support and resistance, I'm not shy to say that, lose all those proximal and distal lines that confuse the heck out of you, right? I'm not shy to say that, and I'm not bashing that program. It works. It works for a lot of people, but I'm teaching you how to trade options, not stocks. Let's, be very, very clear about that, and also have little patience for people who don't believe in themselves. So this is not a baby class. This is an adult class. We're going to be looking for things that work, right? So with all the, with that in mind, I'm very respectful of my students, knowing that these people, they're paying me a lot of money to teach them to do something. And my success is also based on their success and helping them. So it gives me great satisfaction when I see you making that $100, that $200, $300, and so on and so forth. There's a lot of joy in me that in my heart. So it's results driven. That's the most important thing. Cleber is asking how much it is. At the moment, it's 3,500. Yeah, I may go up, but it's 3,500. Does that help you? Oh, your name disappeared. Was it Charmaine? How do I?
Yeah, it's Charmaine. You've been saying it right. So no,
okay, all right,
totally
all right.
helpful. Thank you.
All right, awesome, Miss Phillips. Cool, very cool, very cool. Yep. So that's me in a nutshell. This is Saturdays with Eddie, and I am out for the weekend. Adios.
Thanks, Eddie.
Thank you, Eddie.
Thank you.
Adios, amigo.
Adios, amigo.
Thank you so much, Eddie. Thank you.
You're welcome. All right.
Thanks a lot.